Hello viewers, welcome to our today's video where we will be learning about the Enron scandal. Enron Corporation was a major US energy company that got involved in a financial scandal that occurred in the early 2000s. The scandal involved the company engaging in fraudulent accounting practices to hide its true financial condition and inflate its stock price. It involved a series of events that resulted in the bankruptcy of the U.S. energy, commodities, and services company Enron Corporation and the dissolution of Arthur Andersen LLP, which had been one of the largest auditing and accounting companies in the world. Before going into the details of the scam, let's first understand the founding of Enron and its rise. Enron was founded in 1985 by Kenneth Lay in the merger of two natural gas transmission companies, Houston Natural Gas Corporation and Internet, Inc. The merged company, HNG Internet, was renamed Enron in 1986. After the US Congress adopted a series of laws to deregulate the sale of natural gas in the early 1990s, the company lost its exclusive right to operate its pipelines. With the help of Jeffrey Skilling, who was initially a consultant and later became the company's chief operating officer, Enron transformed itself into a trader of energy derivative contracts, acting as an intermediary between natural gas producers and their customers. The trades allowed the producers to mitigate the risk of energy price fluctuations by fixing the selling price of their products through a contract negotiated by Enron for a fee. Under Skilling's leadership, Enron soon dominated the market for natural gas contracts, and the company started to generate huge profits on its trades. Skilling also gradually changed the culture of the company to emphasize aggressive trading. He hired top candidates from MBA programs around the country and created an intensely competitive environment within the company. The focus was increasingly on closing as many cash-generating trades as possible in the shortest amount of time. One of his brightest recruits was Andrew Fastow, who quickly rose through the ranks to become Enron's chief financial officer. Fastow oversaw the financing of the company through investments in increasingly complex instruments, while Skilling oversaw the building of its vast trading operation. The bull market of the 1990s helped to fuel Enron's ambitions and contributed to its rapid growth. An online trading division, Enron Online, was launched during the dot-com boom, and by 2001 it was executing online trades worth about $2.5 billion a day. Enron also invested in building a broadband telecommunications network to facilitate high-speed trading. As the boom years came to an end and as Enron faced increased competition in the energy trading business, the company's profits shrank rapidly. The collapse of Enron, which held more than $60 billion in assets, involved one of the biggest bankruptcy filings in the history of the United States. It generated much debate as well as legislation designed to improve accounting standards and practices, with long-lasting negative impact in the financial world. Enron created a complex network of off-balance sheet entities called special purpose entities that were used to hide debt and losses from investors and regulators. The company also engaged in accounting fraud by manipulating its financial statements and earnings reports to make it appear that it was more profitable than it actually was. Enron's senior executives, including CEO Kenneth Lay and CFO Andrew Fastow, were aware of these and participated in these fraudulent activities. When Enron's true financial condition was revealed in late 2001, the company's stock price swooped and it filed for bankruptcy, resulting in the loss of jobs and investments for many employees and investors. In February 2001, Skilling took over as Enron's chief executive officer, while Lay stayed on as chairman. In August, however, Skilling abruptly resigned, and Lay resumed the CEO role. By this point, Lay had received an anonymous memo from Sharon Watkins, an Enron vice president who had become worried about the Fastow partnerships and who warned of possible accounting scandals. The severity of the situation began to become apparent in mid-2001 as a number of analysts began to dig into the details of Enron's publicly released financial statements. In October, Enron shocked investors when it announced that it was going to post a $638 million loss for the third quarter and take a $1.2 billion reduction in shareholder equity owing in part to Fastow's partnerships. Shortly thereafter, the Securities and Exchange Commission (SEC) began investigating the transactions between Enron and Fastow's SPES. Some officials at Arthur Andersen then began shredding documents related to Enron audits. As the details of the accounting frauds emerged, Enron went into free fall. Fasto was fired, and the company's stock price plummeted from a high of $90 per share in mid-2000 to less than $12 by the beginning of November 2, 2001. That month, Enron attempted to avoid disaster by agreeing to be acquired by Carnegie. However, weeks later, Carnegie backed out of the deal. The news caused Enron's stock to drop to under $1 per share, taking with it the value of Enron employees' 401k pensions, which were mainly tied to the company's stock. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection. Many Enron executives were indicted on a variety of charges and were later sentenced to prison. Notably, in 2006, both Skilling and Lay were convicted on various charges of conspiracy and fraud. Skilling was initially sentenced to more than 24 years but ultimately served only 12. Lay, who was facing more than 45 years in prison, died before he was sentenced. In addition, Fasto pleaded guilty in 2006 and was sentenced to 6 years in prison. He was released in 2011. The scandal resulted in a wave of new regulations and legislation designed to increase the accuracy of financial reporting for publicly traded companies. The most important of those measures, the Sarbanes-Oxley Act 2002, imposed harsh penalties for destroying, altering, or fabricating financial records. The act also prohibited auditing firms from doing any concurrent consulting business for the same clients. Subscribe to our channel to learn more about the truths of scams from all around the world.